How's everybody doing today? Good? All right. I want to thank everybody for being here. My name is Mark Sebastian. This is Creating Income with Options. So just a reminder that if you lose money, it's your fault, not mine. That's basic. All these disclosures, that's what they say. Everybody's always like, what's all that legally? Basically, it's your own fault if you lose money. That's all it is. So for those of you who don't know me, this is me. Renee gave me a nice, a really nice intro. A little bit more. I was a floor trader for about a decade. I then went and started Option Pit. We're an education and consulting operation. I work with individuals, teaching them how professionals trade, and then I work with professionals, helping them do implementation, testing, and things like that. So, for instance, a couple weeks back, I had a Canadian advisor come in for a couple days, and we worked through some hedging strategies. In addition to that, I run two hedge funds. One that is a vol strategy and one that is brand new. It's called the Broad Cap Edge Fund. So we are trying to do like a smarter way of being long the market. So that's about me. This is me plus 10 pounds, minus 10 years, something like that. Or maybe plus 8 pounds, minus 8 years. I think I would make that trade. As you can see, I do some television here and there. So let's talk about how we trade options for income. So in selling options, traders run their own insurance company. So I'm going to talk to you about how insurance companies make money, how it relates to option trading, how to identify under and overpriced options, how to generate position selection routine, conditions of volatility that produce optimal conditions, and then at the end, we'll use my checklist and we'll actually try and develop a trade with your help using my checklist. The insurance business. All right, so the insurance business makes money selling insurance policies to many individuals. The idea is that only a fraction will redeem at any one time. This leaves the insurance companies with excess capital to invest. The risks are spread out over a large area. They reduce their risk buying insurance back on the reinsurance market. A lot of you probably don't know this, but insurance itself is not very profitable. But taking that float and investing it is. Who's the hot Reddit? That's Liz Clayman. So options are like insurance because when you sell an option, you're basically selling a policy. You're collecting dollars up front for an obligation to pay a claim later. Selling an option generates a credit up front, and when we actually have interest rates, it actually does pay interest rates in your account. And in return, you're taking an obligation of buying or selling the underlying security at a set price in the future. So let's just quickly compare the two. So this is how I would compare options and insurance. All right, underwriting and pricing is going to be your trade selection. Underwriting is how they choose the client, and then pricing is what they charge the client. Then risk management, that's how not to lose a bunch of money. That's reinsurance and claims processing. So in essence, dealing with your losers and hedging yourself off. And then there's customer acquisition, which is trade execution. And then insurance companies have investment operations. Your trading, your income strategy is an investment operation. And here's some examples. You have market selection, pricing, strategy selection, time frame, risk management, and these are key. Position sizing and money management. You have no idea how often I see people blow up because of poor money management skills. They don't know how much to put in every trade. It's pretty important. And then buying options to hedge, things like that. And then you've got disciplined closing, portfolio diversification, and the trade execution is how you do the trade. route selection, strike selection? Do you leg into your trades? Are you using charting to get in? It's pretty. So then you've got kind of support functioning, which is your trading plan, your trading infrastructure, and your learning processes. All right, so 1, are you learning from your mistakes? 2, what does your trading room look like? So for instance, I'm in my office in downtown Chicago right now. Here's what my trading office looks like. I have a couple of bottles of red wine. I've got a glass of water, got my cell phone charging, and I've got the game show network going on behind me. And then I've got a couple of trading screens in front of me. So yes, even though I do business network television, I don't watch business network television. So let's talk about how to build this plan. What markets to trade? All right, so first, how do you tell if an option is fairly priced? How do you tell if an option is fairly priced? So remember, insurance companies, they want to sell overpriced policies. All right. Are most of the inputs of the option model, do we know what we're looking at when we are trading? So let me just talk about how insurance companies work. So insurance companies have this actuarial table, right? So if I walk into a State Farm office, they know exactly what to charge me. Based on assuming I'm honest, they know exactly what to charge me, right? I've got 2 kids, I'm 39 years old, I don't smoke, I'm like of normal weight. They know what to charge me for auto, life, you name it. All right. So they can put out hundreds and hundreds of policies, thousands of policies, and they know, every now and again, I might kick the bucket early and they'll have to pay out quicker than they're expecting. But more often than not, they'll, they'll be in a position to do well because, there are thousands of people will get to that median age. Now, option traders, we have pricing models. There's Black-Scholes, there's all kinds of models, but they all rely on 5 basic factors. All right, and here's what we know and here's what we don't know. All right, 5 things go into the Black-Scholes: cost to carry, strike price, stock price, timed expiration, and forward volatility. All right, cost to carry is interest minus dividends. That's not that hard. Strike price. If you don't know the strike price of an option, never trade an option, ever. Stock price, again, you should be able to figure out the stock price. Timed expiration. All right, if you can't figure out how long it is until the option you're buying expires, I have an 8-year-old in 2nd grade that will gladly teach you how the calendar works. All right, he's got it mastered because he always knows how many days until his birthday and Christmas. So, the only thing we don't know is forward volatility. What is forward volatility? What is forward volatility? So someone said IV. That's implied volatility. Price action in the future. That's correct. So it's not implied volatility. It is price action in the future, not what's happening today. So the thing is, we don't know forward volatility. Nobody does. All right. If you knew forward volatility, that would basically mean you saw the future. You don't. Good news. All right. So Since we don't know forward volatility, that is why we get implied volatility. So what is implied volatility? It's simple. All right, you've got your options price. All right, and then through a differential equation, we use the factors, the stock price, the strike price, the cost to carry, the timed expiration, and the volatility. And I'm just using additions, but it's really a very complex differential equation. So then basically algebraically, we take volatility over to this side, and we take the price of the option over here, and we solve for volatility. In solving for volatility, that is where we get at the money implied volatility. All right, so is at the money volatility right though? So I want to show you something. This is a chart of the S&P from, call it January 18th. All right. Here's implied vol. All right. And this is what the market is guessing the next month will look like. 30-day implied vol. This blue line is historical volatility. So what is historical volatility? That is what has happened the previous 20 days. So think about it this way. The implied volatility here all right. So what's happening, what this mark really represents what the mark was guessing here. What do you notice? In fact, what do you notice this entire period of time? So they're doing Who Wants to Be a Millionaire now on Game Show Network. And so what I would point out is that, in fact, the implied vol is actually above where historical caught. Right, Ivy is higher. So anyway, yeah, they're doing Who Wants to Be a Millionaire, and this really nerdy guy apparently writes a feminist comic book, and I was just thinking about how funny that is. So looking at historical, which is sometimes called realized volatility, and implied volatility, a couple things to think about. Is there a trend in realized volatility? All right. Is there a trend? Is the policy too expensive or too cheap? Has it been too expensive or too cheap? So for instance, what about this policy? The one that we would have traded right here. Is that too expensive or too cheap? Let's take a look. Well, let's take a look. Here we are on the 18th. Well, so far, not so good, right? Movement is actually, there's actual real movement. And you can see what's happened to the value of that insurance policy, right? Right, pretty interesting. Come on. Oh, whoops. Let me get to where I was. That's not the presentation I was working on. Here we go. Why is this not opening up all of a sudden? I believe this might be frozen here, folks. Sorry about that. All right, we'll come back. This is an older presentation, but we'll come back to this. So I do need my kid to help. So is the policy too expensive or too cheap? Thank you. Thank you. He just made his travel squad. Then, so what to ask? All right. What is the current realized volatility SPX? How much is the market actually moving? All right. Sometimes called realized volatility. All right. Make sure you interpret the HVA the right way, right? Will the next 30 days be like the last 30 days? That's an important question. So take a look here. You know, the white line is 10-day, and that blue line is 20-day. So they look like they're rising, but what just happened to volatility? It's dropping. So there might be a real change in profit. You know, there might be a real change in movement. Here's another one, right? What's happening here? All right, picture one, it looks like vol's dropping. Picture two, looks like it's kind of bottom and it's starting to rally. So let's talk about the different periods to look at. 10-day HV is too short a period to evaluate how much we're actually moving, but it can give us a clue into what exactly has happened in the last couple of days. Was there something that just happened? Did we just have something affect what we're doing? All right, 20-day, that's 1 month of trading data, right? We don't trade on Saturdays and Sundays, so 20-day HV is essentially the same thing as 30-day I is what 30-day IV is trying to predict. It's good for looking at what the market is actually doing now. All right, then 30-day. So 30-day is more like 5 or 6 weeks. And it has less noise than 20-day. It's good for traders who want to trade more part-time than full-time and really just really care about what the current trend is. And then 60-day HV is kind of the longer-term market trend. All right. So that's kind of exciting. And then the other piece to think about is always look at a price chart to see if there's something not coming through HV. So, you know, when I was messing with live vol there, I have to reopen. I don't know why, but it froze up. So let's take a look here. All right, and you know, let's look. You've got some, you can have some really funky candles that can make HV seem wrong, right? Or there can be a trend that makes HV wrong. So for instance, you can have really low volatility, but what if all the movement is in one direction? Is it going to act the same as a normal low volatility portfolio? No. No, it will not. All right. So falling versus realized volatility is going to be the #1 determiner for how strangles, condors, and credit spreads perform. All right. So the other main portion of those is going to be implied volatility. But that's really the key. Strangles and condors are all about realized vol. So if you are a big strangle trader and you were selling strangles last week, you're probably not very happy right now. Probably got worked on both ends. All right, now let's talk about how much about implied vol. Implied vol is how much the market is expecting something to move over a period of time. It has a mean reversion over the long haul. However, it's more useful to look at the median and the mode than the mean itself. All right, and so you want to use exact durations to look at what's going on. All right, 30-day IV is what might happen soon. 90-day IV is the longer term vol trend. And one thing to remember is, you know, volatility does revert. Volatility does revert, but it can take a very long time to revert. Years. All right. So implied volatility and fair value. So if fair value is kind of the equilibrium where selling and buying are matched up. However, it moves around and it can get out of whack. Fair value can be too high, it can be too low. Right now, as I look, I think fair value is probably a little too high. Doesn't mean it can't go higher. All right. Then there are periods of time where fair value gets way too low. You know, when the VIX got to into the 8s, fair value was too cheap. So here is IV. Now here are the period. You can see periods. You know, fair value probably too cheap here. Fair value too expensive here. Probably here. All right, so implied volatility is going to be the #1 determinant of how straddles, strangles, and debit spreads perform. Secondarily, the determinator is HV or realized volatility. Pretty simple. Now, let's talk term structure. So we're hitting all the different pieces of implied volatility. So using IV, look at a term structure. Is 30-day IV below or above 90-day IV? Is 30-day lower or in contango denotes a calm market? Should be considered a logical market. The market is less likely to be unreasonable. Watch for a spiking market, though. It can denote near-term trend change. All right. If the market is in backwardation, that means 30-day IV is higher than 90-day IV. The market is less logical. It is much more reactionary. it is less likely all right, is less likely to follow a trend. And you know, who here has a really regimented trading program with options, or you know, they trade these things that have names to it? I trade the easy breezy, beautiful butterfly. I trade the no tums needed iron condor. I trade the lazy man calendar spread. You know, does that ring a bell to anybody? Probably, right? So those work all well and good until you get an illogical market. All right. So here's what I will tell you. If you take nothing from this presentation, all right, if the VIX futures curve is messed up, here, let me show you this. This isn't helping. So take a look. We currently have the cash index trading at a premium to Feb and March and April. We're also in a position where Feb and March are pretty flat. This market is telling you that if you think that you know, your super regimented plan is going to go off without a hitch, you are incorrect. This market basically says throw out what you know. This one does that even more so. So right now all we have is the VIX over the futures. When you have futures in VIX in backwardation, you definitely are going to need to throw out your plans. All right. If you don't have my stuff, you can use VIX and VXV, VXMD, all these middle ones. So within contango backwardation periods, there may be a time where options seem under overpriced in 1 month or another. Look at current mean relationship levels. If VIX has been trading at 1 point under VXV for the last 90 days and moves to 2 points under, something changed, right? In normal periods, supply and demand create trades. Traders looking to sell premium or buy premium can really move around volatility. Term structure is going to be the #1 thing that drives calendar spreads. Double diagonals, diagonal spreads, then the #2 is implied volatility. This is term structure. Look at all these different contracts. Every implied volatility is different. I can tell you they've consistently been pricing the Monday in the S&P 500. They've been consistently pricing Monday premium too cheap. So we have been running a calendar strategy. We're not doing it really right now. We've been running a calendar strategy that is buys Monday options. All right, so now let's go through my checklist for developing a trade, and then we'll develop a trade on a stock that you guys like. All right. So somebody give me a stock to look at, and preferably not one that already had earnings. So like a McDonald's or a Disney or IBM or Netflix, somebody that's already got earnings out. Apple has earnings this week, so that would not be one I would pick. I've seen Netflix out there. Intel is great. Intel or Costco? What do you guys think? Intel or Costco? Real fast. All right, we'll do Intel. All right, so here we are. Intel down $1 today, but let's take a look at the chart here. All right, they had earnings. Obviously, it had a really nice run, had a little bad press, but continues to move higher. Even with this down move, it's moved higher. All right. So I would say the price action is moving higher long term, wouldn't you? All right, up next on my checklist. What is the HV? So the best trade for the price action is long. What is the best trade for the HV? Now, obviously, we had earnings, but even without earnings, what is the trend of HV here? What do you notice on this trend, even without this jump here? What do you notice? Flat to, I would actually say probably rising, wouldn't you? All right, so you have a rising volatility. All right, is that something that is going to be great for like an iron condor or a strangle? If we got rising movement. I'm going to say no. I would be buying that. I'm going to be buying this market on the close. I think we're going to be we're due for a relief rally tomorrow. All right, so now let's look at IV. I'm going to say that IV is slowly rising. 30-day is falling and looks like it's heading down here. This is Live Vol X. So there you. So I'm going to go and say you've got a positive term structure. You really do, and you've got an implied volatility that in the longer dated stuff is not that crazy. So I've got positive term structure, right? Price action, we'll just write it in here, right? Higher. Well, it is rising. Best trade for IV, I would say it's definitely flattish, maybe rising. Term structure, it is in backwardation. So if I have a rising IV, rising underlying HV and IV with backward term structure, what do you think? What trade do you think is going to fit? See how we're putting all these pieces together? Debit spread could make some sense for sure. I think that you'd either want to do a debit spread, a bull, butterfly, or a calendar spread. I, as you can see, have from a couple days ago a debit spread. It was looking a lot better yesterday. I probably should have taken it off. Probably should have taken it off when we got to 50.85, don't you think? especially considering how well it was doing the day before. All right, if I was going to do something right now, I might throw on a calendar spread instead. I might throw on the March 50 Feb expiring Friday 50 calendar spread. You know, I could move it back a week. We're getting this nice vol pop here. I can move it back a week. That's not bad either. But I kind of like the calendar spread too. I'll put that in. See if I can get 94 on it. Let me make my summary of my offer, and then we'll look at one more. All right, so summary: insurance companies make money selling dollars. Option traders have to find premium that's trading for more than it's worth. Learn to read price, HV, IV, and term structure, and use the information the market is giving you to create the right trade. Here's my offer. All right, so last fall, we did a 10-session, 15-hour course called the Option Pit Income Trading Masterclass. All right, and it was 10 really good sessions on buying and selling decisions, credit and debit spreads, straddles, strangles, condors, butterflies, calendars. We spent a ton of time. We did a little bit of stuff on VIX. We did some hedging, and we did some stuff that really you're only going to learn from us. This is an amazing course. We charged $14.97 to view it on our. If you went into our store and bought it, it would cost you $1,497. Between now and next Tuesday, the 6th, I'll take $1,000 off. Go to optionpit.com/IMC. Use code II1000. Must be capital. II1000. That's optionpit.com/IMC. And if you take the course and you don't like it, I'll refund your dollars. But you will. All right. Any questions? This will be the best $497 you ever spent. Not best. I mean, unless you bought like your wife's wedding ring for $497, then that would be better spent. But not your ex-wife. If it's your ex-wife's wedding ring, well then maybe that's not better spent. But in terms of trading, like I said, if it doesn't work, if it's not the right course for you, then I will refund your dollars. So it's pretty risk-free, and you're getting, you know, basically 2/3 off. It's a really good class. I should know. I taught a big chunk of it. All right. Any questions? All right. That's good. I think I've got 3 minutes. So how long are the class sessions? They're each about an hour to an hour and a half long. But they're recorded, so you don't have to watch the whole thing at once. All right, let me look at Costco real fast. Keep the questions coming. I'm happy to answer them. Wow, Costco. Trend is higher. Guy's a D-bag. The vol's definitely rallying. The movement is not. So, oh, geez. Why is that still worth that much? Jeez. I'll tell you, I think this is a good debit spread. How important, you don't need live vol to a class. Andrew actually mostly uses TD. Which is toss. You can use toss. It works fine. I'll tell you, I think that Costco looks like a good credit spread, right? Does that add up? You do that bull term structure, but I think I'd be a credit spread seller. Let's take a look. Yeah, I think I like selling credit spreads. Calendar could work too. I think the vol is high enough that I'd rather sell it. If you look at the implied volatility here, I think that the fact that the movement is sinking while the implied volatility is going up, I think it looks like an interesting credit spread sale.